What does 2015 portend for the global economy? I have with me the day before the WEF starts and all the action begins right here on the main promenade of Davos, Nariman Behravesh, the Chief Economist of IHS. Mr. Behravesh, thank you very much for joining us. Looking forward to all the action here in the next few days.
Oh, always.
Well, it's going to be an interesting opening to the year. I don't think that Davos in many years, at least in the last 2 or 3 years, has seen these many global growth questions before it. So I'm going to start by asking you to identify what you think will be the top 2 or 3 concerns that the global economy will have to grapple with in 2015.
I think the first is the Eurozone, whether or not it can sustain any kind of growth, and especially what the European Central Bank is going to do. But then very importantly, China as well. China's slowing. The question is, how slow will growth be? If you look at the annualized growth rate in the fourth quarter, it's 6.1%, which is very, very weak for China. So the concern is that sort of the bottom, or is it going to continue to decelerate some more? So I think economically, those are probably the 2 big questions, Eurozone and China.
Okay, you've said in your briefing note prior to Davos that the period that we're going through in the global economy reminds you of the 80s and 90s. Talk us through why you think that's the case, and then I'll get more detailed in my questioning.
Sure. There is sort of a back-to-the-future element here. We have the U.S. growing very rapidly now, much more so than it has in a number of years. It is becoming an engine of growth once again in the global economy. That's, again, reminiscent of the 80s and 90s. The dollar's strong. It's helping, actually, the Eurozone and Japan because their weak currency is helping growth. For the first time since the 1990s, the U.S. is the biggest oil producer in the world. So all of these are very reminiscent of 20, 30 years ago.
Do you think oil prices and the crash that we've seen in them will do more for the global economy and for growth than central banks have managed to do over the last few years with their quantitative easing programs?
Ironically, I think certainly for Europe the answer is yes. Whereas for the U.S. it's a bit more balanced because the Fed has done a lot for the U.S. economy through quantitative easing. But for Europe and the Eurozone in particular, I think the oil price drop may actually do more for growth than the European Central Bank.
There are also negatives in terms of the impact of the oil price drop, instability in Russia, in countries like Venezuela. Net, do you think the oil price, what impact do you think the oil price drop will have?
There's no question that there are losers as well as winners, but our view very much is that net, it is a positive effect on growth for 2 reasons. One is the oil importing economies, namely the U.S., Eurozone, China, Japan. These are huge economies in the world. So the biggest weight in terms of global GDP. But very importantly, their propensity to spend this windfall is higher than the propensity to spend of the oil exporters. So again, as you shift money from the oil exporters to the oil importers, you're going to get more growth.
And you've assessed it at a $1.5 trillion shift?
It's about $1.5 trillion in terms of a wealth shift. Assuming oil prices stay where they are right now, it's about a $1.5 trillion shift from the oil exporters to the oil importers.
Okay, this year is also going to mark 2 interesting trends. Currency volatility. We've seen what the Swiss National Bank did last week in anticipation of ECB action this week, and maybe divergent central bank action for the first time in many years. So probably the Fed will look at raising interest rates in the second half of this year, while we still have the ECB and the Bank of Japan looking at easy monetary policies. Let me start first by asking you what you expect the ECB will do this week, and will it be effective in helping Europe fight the deflation problem?
Our best guess is the ECB will launch about a 500 billion euro bond buying program. That's good, but it's not enough. I think in the end the ECB will have to do much more than that, but it's a good start, so it will help. So from that perspective, I think it's a good first step is the way to describe it.
Okay. Will it help Europe fight deflation?
I think it will help.
So will they have to do multiple sort of versions of this?
Our guess is they'll at least have to do another round a little later in the year to really sort of make sure and guarantee that we don't slip back into deflation. But it's a start. It's a good start is the way to say it, assuming they do it, of course.
Okay. What will that mean for currency volatility across the world?
Well, it certainly will mean a weaker euro and correspondingly a stronger dollar. So I think that's in the cards. And I think there's certainly a distinct possibility that we could see parity between the euro and the dollar sometime in the next few months. So we're headed in that direction, so it's entirely possible.
What does it mean for both the economies? What does it mean for countries like India that do trade with Europe as well as with the U.S.?
Well, I think, in terms of the U.S. dollar, it will certainly hurt exports a little bit, but the good news is the U.S. can afford that. It's growing strongly, so a stronger dollar is not going to hurt very much. But this is a lifeline for Europe. I mean, a weak euro is desperately what Europe needs. So in that sense, it's a good way to sort of rebalance growth a little bit from the U.S. to Europe.
Okay. And the central bank divergence, what do you make in terms of the impact that will have?
Well, again, it's the logical impact it will have is a stronger dollar, weaker euro, weaker yen, and in the case of India, certainly assuming this recent cut that we had is the first of many, it'll probably mean a slightly weaker rupee as well.
Do you think India looks in a better position at the beginning of 2015 than it has in the last few years?
We're very optimistic about India. We think it'll grow probably 6.5% this fiscal year, and I think it's set to grow probably a little faster than that in subsequent years. We're in this ironic situation in the next few years. You could actually see faster growth in India than in China.
Well, it's not ironic for India for sure, but do you think that India can be to the world and the global economy what China has been? Because China's sort of structure of growth and nature of growth is very different from what India hopes to achieve.
I think the structure of their economies of India and China are very different, but nevertheless, a strong, rapidly growing India will be good for the global economy. There's no doubt about that, for any number of reasons. But it will take probably another 10 or 20 years for India to achieve the kind of global, say, locomotive role, if you want to call it that China now has. It will take time, but it's entirely possible, and we're fairly optimistic, as I said, about India.
Okay. One challenge that we haven't discussed as yet in the context of the Eurozone and all its problems is the potential or the possibility of a Greek exit. It seems to be a very low possibility from what everyone I speak to tells me, but are you factoring in what that means for the Eurozone?
We have factored it in. We do think the probability is less than 20%, for example, of a Greek exit, assuming the left-wing Syriza party wins even. But even if Greece were to exit, we think everything that the central bank, the European Central Bank, has done, all the other policies that are in place, that the contagion from a Greek exit would be fairly small and fairly minimal should it happen in the next year or two.
Okay, we've just come off a week where the IMF downgraded its prospects for global growth this year and for next year. What is your outlook on whether we're entirely out of the woods with regards to our recovery from the global financial crisis, or we have at least another 5 years to go maybe?
Well, the IMF did lower their forecast, but they lowered it to where we are in terms of our outlook for the global economy. So in that sense, we agree with their recent change. But even they assume there'll be a slight acceleration in growth in the global economy this year compared with last year. But I think we are still in this process of slowly recovering for that horrible recession that we had in 2008, 2009. So that recovery process has been incredibly slow. It often is after you have one of these financial crises. So it's no surprise that we are still sort of stuck in these doldrums. Good news is some economies like the U.S. have come out fairly rapidly. Others will follow in time.
So do you think this will be a more cheerful Davos meeting than it has been in the last few years?
I would say that the mood is a little more cautious this time, partly because of the troubles in the Eurozone and in China. But I think there's still some optimism, some cautious optimism. A lot depends on where you are in the world. If you're from the U.S., you're optimistic. If you're from the Eurozone, so-so. If you're from China, you're a little worried. So I think if you're from India, you're very optimistic. So I think a lot depends on where you're from.
What are you looking forward to most in Davos this year?
Well, what I'm hoping is that we start to see some positive changes in terms of policy, especially monetary policies, out of especially the European Central Bank and the People's Bank of China, for example. Maybe more interest rate cuts there. So a little more proactive policies coming out of the central banks in particular.
All right. Mr. Behravesh, thank you so much for your time, and have a great WEF meeting. Thank you.
You too.